How's it going, everyone? Mario here. Before we get started, can you guys hear me? I hope everything is alright, and I hope your day is good. The market is opened. In this session, we are going to talk about risk management and the importance of it, and what to do and what not to do. I've been in this business for almost 4.5 years now, and I've spoken to a lot of new traders in particular. So a lot of stuff which I heard, which actually kind of concerns me, even in our own Discord server. Taking trades without any plans, taking trades without any stop losses, everything concerns me. So we will touch over what is risk management and what are the importance of it. And you will, after this, by the end of this presentation, you'll come to see, even knowing zero about technical analysis, you can still be in a higher position compared to that of the people who trade with technical analysis and with no regards to risk management. All right, so first and foremost, the first question is, what is risk management, right? So the textbook definition goes something like this: the process of identifying, accessing, controlling, limiting the exposure of drawdowns in case of an unforeseen events or circumstances before it spirals out of control. So if you actually run a business, which is other than trading, if you run a business, and you should know what all the potential risks that you might be facing in the future, and you will be taking necessary precautions leading into that event. If it happens, it happens. If it didn't, it didn't. Same goes for the car insurance, right? You pay for your car insurance because just in case something happens, that insurance will come in handy. It doesn't mean you're going to get into a car accident, but if something happens, the insurance company will cover for it. So that's the premium which you pay on a monthly basis, like $300, $200, depends on which insurance you have. You'll be paying it on a monthly basis in order to protect yourself from potential damages in the future. See, that is one of the biggest example of risk management which we use on a day-to-day basis, the car insurance. So now there are 4 categories: identifying the risk, accessing the risk, controlling the risk, and reviewing the controls. And now we set a real-time example. We got to get into what it means when it comes to the trading point of view. So now, let's say you're taking a trade. So before even you're entering the trade, you should know how much money you're risking and how much money you're willing to lose, and how much, if the trade goes absolutely against your favor 100%, you should know how much money you will lose completely, 100%. Let's say if you take into an option contract, right? If you enter an option contract which is of $600 worth, the total amount of risk in that option contract is $600. You can lose that $600 if things go tits up the next day. So now, once you know this, the next step comes to, what are you going to do about it? How are you going to prevent yourself from the drawdowns like this? And what are the potential scenarios that can happen which might cause you to lose that complete $600? So that is accessing the risk. And now we're getting into the control. This is where the stop losses and everything comes in. So now, controlling the risk is, you damn well know that you can't afford to lose the complete $600, in this scenario at least. So now it's up to you to control that risk. It's up to you to decide how much you're actually willing to lose. It can be 600, it can be 500, it can be 400. Depends on the complete individual at the end of the day. Now we're going to touch into the reviewing the control parts. How are you going to review your controls? What do you mean by that? So now let's say you enter the trade with the stop losses and you have your plan. And you got to keep an eye out for the stop losses as the trade goes higher and higher and higher. And you got to move the stop losses higher and higher so that you're getting your initial investment back. 1. And let's say the trade goes up 20-30% from your initial entry. What you do is you take the stop losses from the under and then you move it to the break even. So technically this is a risk-free, emotionless trade because you're not losing your initial premium. And the $600, let's say you enter the trade, and then currently the option contract is at $900, and if you move the stop losses to that 600, it doesn't matter anymore. If it goes up, it's free money. If it goes down and the stock goes down and then comes back to break even, you don't lose anything at the end of the day. It's like risk-free, emotionless trade. So these are the 4 categories which you need to keep an eye out for: identifying the risk, accessing the risk, controlling the risk, and then reviewing the controls. And now we will go over what not to do first, and then we will cover some of the back testing which I did on the risk management when it comes to risk to reward, and we will talk about that by the end. So by the end, you'll be having an idea on how to go about it if you're trying to implement it in your portfolio. So the first one, don'ts number 1. So I have seen a lot of new traders. This kind of surprises me. When I ask them what's the plan, they don't know. They don't know the answer. They just say like, oh, I set my stop losses at 10% and I see profit, take profit. The first things first, 10% of the stop losses in the options that you're getting is a kind of a slippery slope. So if you have an account of $2,000 and if your option contract is like $500, 10% of 500 is like 50. And if your option contract is like you just YOLO'd your entire account in this one option, the 10% of the $2,000 will be somewhere around 200, and 10% of $1,000 will be 100. And it's like, you see what I'm saying? It's not a standard value. It varies, depends on the option contract's price. And the stop losses should always be placed with the overall account size and not with the size of the options contract. So what I mean by that is, if you have an options contract and if you set your stop losses at 10% in that option contracts alone, how will you know that how it's going to affect your overall P&L? Let's say like you took 5 trades with an option contracts worth like $20, and then you're just constantly securing profits at 5%, 5%. And if you took a trade for like $500 next, and then you lost that 10% later, it's going to impact your P&L in a massive way. So there is no way of knowing how much you're actually risking if you're setting your stop losses based on your option size instead of your account size. So your account size should come first. And then you can set your stop losses later into the options contracts depending on what the contracts move. The first things first is the overall account size. Don't lose sight of that. So the don'ts number 2. If you've been in my Discord for a while now, you should know how big I am with stop losses. Anyone who says that I enter the trade without any stop losses, well, it's not a good thing to hear from a trader. It's a beginner mistake, which a lot of people make. Entering an option without stop losses? Nope. Entering a share without stop losses? Yep, 100% no. It's a big red flag whenever you hear someone say, I don't have any stop losses in my options contract or in my position. The only thing which I'm okay with not having stop losses is QQQ and SPY, because those are meant to be a long-term holds, and statistically speaking, these always goes higher. If in 5 years or 10 years, doesn't matter. It'll be trading higher than where it is trading at the moment. Those are the only 2 exceptions where like, okay, no need for stop losses, just let it go. I mean, indexes rebalance themselves, and SPY and QQQ always goes higher. It's a safe investment. So other than SPY or QQQ, every single trade, doesn't matter if it's Apple, doesn't matter if it's Tesla, doesn't matter if it's Microsoft, doesn't matter if it's Meta, just because they're a FANG doesn't mean you shouldn't have stop losses on. Simple as that. You saw what happened to Netflix, you saw what happened to Facebook. What stopped the same thing from happening to Apple and Microsoft? You'll never know. You got to protect yourself at all the times. And the amount of traders who enter a trade with no regards of a stop losses or even a basic plan is actually scary. They just want to enter the trade. They call it in and out. In and out of what? A restaurant? No. You got to know where you're entering. You got to know where you should be exiting. You should know the stop losses. You should know where to cut the losses even before entering the trade. If you're one of those traders, it's all good. You're just starting, you're learning, and it's fine. You need to take a step back and reevaluate what you're doing. Now, consider this like a business. So let's say you're opening a restaurant, all right? So before opening a restaurant, what you'll do, you'll plan. You'll be planning on what the demographics are and what type of restaurants you have as a competitor and what flavor you're going to offer to the customers. Is it going to be Mexican? Is it going to be Indian? Is it going to be like American? Is it going to be Jamaican? You got to plan every single thing before opening a restaurant. You don't just open a restaurant and then ask these questions, do you? Then why is it any different before taking a trade? This is a business and you got to treat it like one. Anytime you enter or exit a trade without understanding what you're doing, it is considered as gambling. If you don't have a plan, don't enter. It's okay to not make any money than losing money. It's okay to completely stay away from the markets instead of getting into something which you don't understand anything about and then losing money on. So 1, stop gambling, and 2, stop listening to gamblers. Stop listening to these call-out services which has no regards to the explanation on what they're doing. If you don't understand, question them. What is it about? What are you talking about? I don't understand this. Go ahead, question them. Stop blindly following gamblers, stop listening to gamblers, and stop gambling. Now, what's the don't number 3? Now, this is the important one which I see, at least from the conversations which I have with the beginners. Stop blindly following the call-outs. Just because you see a call-out from someone in the Discord doesn't mean you have to blindly buy it. Again, the same restaurant example. Just because your friend opens a restaurant doesn't mean you'll open the same restaurant in your demographics. Maybe your friend in Los Angeles knows his demographics and then he opened one over there. Just because it works out in Los Angeles doesn't mean it has to work out in Connecticut. You see the difference? The demographics are different, just like your accounts are different. Your account sizes are different. And your friend's account size will be way higher than your account size, or your account size will be way higher than your friend's account size. So this is the problem with following the call-outs blindly. You don't know the guy or girl. Why will you follow someone else straight blindly with the blindfolds on? Again, just because your friend opened a restaurant, you wouldn't jump in and open one just because your friend opened it, do you? Then why is it any different when it comes to trade? And if you're someone new and if you're joining the Discords and you're looking into everyone posting their trades, just because someone says oh, I like SPY puts, you don't just buy SPY puts, you'll ask them, why do you like it? What do you see? That's how you learn. What do you see which makes the statement that you're gonna short SPY? There's a big difference between a trader and a gambler, and a trader asks questions, especially if you're beginning, if you're learning. You'll ask your friend, don't you? What made you open the restaurant? What made you choose the Mexican, or what made you choose the type of the food which you're serving to the demography? What might be your profit? What might be your potential losses? What might be the risk? You'll ask all these questions before opening a business. You should ask all these questions to anyone who talks shit like I'm buying this, I'm buying that. Even for me. If you are a member of the Patreon, if you see a call out and if you don't understand, you gotta ask questions. That's how you learn. I paid such and such to get trades. I mean, at the end, the biggest sucker will be you. At the end of the day, it's your folio we're talking about and no one else has control over it other than you. And now, it all comes back to the same example. You can't open a restaurant just like your friends and then complain about it's not working out because the demographics are different. Demographic difference are there, and the demography of people who are staying in your area might be different from those people who are staying in their area. So it is your trade, it is your portfolio at the end of the day, and you and only you has control over it. So always make sure to associate yourself with people who shares ideas than share their traits. It'll help you out in the wrong run. So don'ts number 3 is stop following call outs blindly. Ask questions. Ask questions before entering anything. So we'll go over again the don't number 1. Set your stop losses based off of your account size, not based off of the options which you got. Don'ts number 2. Never ever enter a trade without a plan, without a stop loss. Never do that. Have a stop loss even before entering. So if you don't have a stop loss, if you don't have a plan, don't enter. Stop gambling. Don'ts number 3. Stop following the call outs blindly. You don't know the guy or girl, so it's your account. Ask questions. If you're a new trader, if you don't understand something, ask questions. Don't follow blindly. Now we spoke about the don'ts. We will go over the do's. What to do. Number 1. A lot of new traders dive into technical analysis. They will go over multiple YouTube videos to learn what technical analysis are. They will spend shit tons of money on multiple courses to learn what it is. And they will buy the bots which will tell you the indicators to buy, indicators to sell, even though I think it's a fucking waste of money. But still, as a new trader, you're interested. The adrenaline is there. You want to learn something new. You want to make money. You want to make it in the stock market. You're like so motivated. You will learn a lot of technical analysis. You will learn about a lot of new indicators. Any new indicators that you come across on YouTube with the title saying, this indicator will make you $10,000 in 2 minutes, bro. Like, yeah, you'll just click it because that is enthusiasm. I can't blame you. But a lot of new beginner traders fail to understand is regardless of what process you use, regardless of what indicators you use, regardless of how you analyze the price, at the end of the day, without a proper risk management, it is not going to work out. If you are a new trader who already lost a lot of money, and right now, if you're stagnating, there might be some period as a trader where like your account doesn't move anywhere. It'll be staying completely flat. It won't do anything. 1 week you'll be up, next week you'll be down, back to the same spot as what you were in the week before. And next week you'll be up again, and the next week you'll be down, back to the same area as where you were before. So it's like if you are in that stagnating area, there is a point where like your process is wrong. You're letting your losses run too far and taking the profits too quick. Simple as that. Now, a few days back, I sent out to the members of the Discord and members of the Patreon to calculate that psychological trigger in your own self on where to take profits and where to cut losses. You had 1 week time. I hope you looked into it and I hope you noted it down on what was your psychological trigger. Let's say you got Apple calls for $150. What's the trigger? What price point makes your mind goes like, oh shit, I gotta sell, I gotta take profits. Same for the opposite. What makes you panic? What makes you cut the losses? Which price points make you cut the losses? You had 1 week to analyze yourself as a trader. Now it's time to take action. So there will be multiple scenarios. We will dive into it one by one. And if you haven't analyzed yourself yet, it's still not too late. Every trade you take, make sure to know what your risk level is. Make sure to know how much, like, where's the psychological trigger? Where are you securing your profits? Where are you securing your losses? You gotta know these numbers. You gotta understand yourself as a trader. It's mostly psychological. It doesn't matter how much good you are in technical analysis. If your execution is not good, it's not gonna help you out in the long run. So, multiple scenarios, we will dive into it one by one. Number 1, the most important thing, letting the losses run more than the profits. So, in that analysis, whatever analysis you made for yourself, if you're comfortable letting that $150 option go down until $100, but if the option prices hits like 160 or 170 and you're panicked to sell, technically you're willing to take a loss of $50 for a $20 profit. If you win like 2 trades and you make 40, and if you lose in 2 trades and you lose 100, even though your profit and loss charts is like 50-50, you still lose $60 in profit because your risk management is shit. So if you belong to the category like setting 10% of stop losses and then see profit, take profit gang, you need to stop it and then change your strategy immediately. By strategy, I mean you've got to let your losses cut quick and then let your runners run. I can understand that if you've lost a lot of money before and if you see money, you're tempted to sell it immediately. But if that's the case, you got to cut your losses even more earlier. If you're taking profits for $5, you got to cut your losses at $1. If you're taking profits at 20, you got to cut your losses at 5. So if one thing is like way quick, the other thing should be quicker. Simple as that. So if you belong to the category of traders where your account just remains stagnant at one spot, regardless of how many wins you take or how many losses, and it just wipes out everything you made, something needs to be changed. Now, this is where we come to what to do. Example of good risk to reward. I have a number here on the screen which is 1.2:4. So if you're a new trader and if you see some traders talk like this, like what's the risk to reward? What's the risk to reward ratio? How much you're risking? What do they mean by that is if you enter a trade for $150, they're asking you what's your total risk, which is the total risk is $150. That's how much you're willing to risk on this trade. And now I have 1.2:4. So this is for the overall account size. We'll give you an example. If you have a $2,000 account, 1.2% of the $2,000 is $24. So the maximum you can risk on one trade is $24. And you secure profits at 4% of 2,000, which is $96. Technically speaking, if you enter an option contract, the maximum you can lose is $24 per trade. And once you see $96, you will be out. Remember, there are only certain trades which can get this risk to rewards. You only take trades like that. This is where technical analysis comes in. With technical analysis, you can actually find setups like this and then incorporate the risk management into it, and thus helps you take your account one step further. There are certain rules which you need to follow when you're having this 1.2:4. If you have 2 consecutive trades, if you take Apple 150, Apple calls 140 strike, and you lost $24 and you get stopped out, and then you buy Apple puts 140 strike, you lost $24 and you get stopped out. That is 2 consecutive trades, 2 losses. You stop trading for the day. That's it, done. If you take 2 losses for the day, it's done for. You don't trade anymore, you don't trade for the particular day anymore, it's not worth it. So you just take your loss and you move on. And now, next day the market opens and you take the same 2 trades and then you lose. Now that was 4 consecutive losses in 2 days. That is like $96 down the drain. And now, when you take a series of consecutive losses, it will have a significant hit in your confidence. It will have a significant risk in your ability to trust yourself, and all these are a recipe for disaster if you continue to keep trading. So if you take 4 losses consecutively in 2 days, you stop trading for the week. Next week you start with a clean slate with a fresh mindset. So first things first, 1.2:4 risk to reward. In a $2,000 account, you can only risk 1.2% of it in one trade, which is $24. If you have a $500 account, 1.2% will be $6. You can only risk $6 to make $24. Regardless of how big your account is, regardless of what the size is, it's going to be 1.2% is to 4. 1.2 is to 4. If you take 2 consecutive losses on the same day, you stop trading for the day. If you take 4 consecutive losses in 2 days, you stop trading for the week. Just like how they halt the stock if they move past so quick, so fast to the upside. Just like how they halt it in the market, if they move down in a really fast way, in a big percentage points, they halt the trade. Just like how it is, you gotta halt yourself from taking more trades if you're on a losing streak. 2 consecutive losses, you stop trading for the day. 4 consecutive losses, you stop trading for the week. You come back with the next week with a clean set of mind. It's mostly psychological. Now, this is an important slide which I need to talk about, because I 100% know most of you, especially in the server of Chris Sane, especially in the server of mine, suffered through this. If you feel tempted to take a trade, or if you feel like, let's say like you lost 4 trades continuously, all right? And you shouldn't trade for a week, that's the rules. But next day when the market open, you see something and you're like, oh shit, I gotta trade it. If you feel like something is forcing you to take the trade, even if the rules exactly says you shouldn't, congratulations, you have something called as gambling addiction. Another problem for you to deal with, because it's a dangerous thing to have as a trader. So, you followed your own method until now. If you're not profitable, then you're doing something wrong. Let's say if you're in the markets for like 2 years, since 2020, and you tried out different things, and everything you do for some reason doesn't work out. You tried support and resistance levels, it didn't work out. You tried a lot of indicators, it didn't work out. You tried volume profile, it didn't work out. Then you gotta ask yourself, there are traders who make money using the same indicators which you used and failed. Where's the problem? The problem is not the indicators or the way you analyze the price is in. The problem is actually in the way you manage your risk. Now, I want to touch back into this gambling addiction. So, have you ever felt that urge to buy calls or buy puts, even if you don't see any decent trades, any good setups which satisfies the 1.2 is to 4? Not even 1.2 is to 4, nothing at all. You won't be seeing any setups. And just because you got missed out on the rally, you want to get back in, so you take some dumbass trade to fulfill that desire to buy and sell. Now that's gonna be a nail to the coffin to the folio. And if you're one of the traders who feels that way, that you got to trade every single day, if you're not trading for every single day, you'll go crazy. There you find the need to look into the Robinhood every 2 seconds that you enter the trade or exit the trade. You need to stop. You need to close your brokerage. You need to take a break. Stop trading for a month until this feeling goes away. Now, this 1.2 is to 4 risk to reward. The rules are pretty simple. Let me reiterate again. If you take 2 consecutive losses, you stop trading for the day. If you take 4 consecutive losses in 2 days, you stop trading for the week. Now, this is an example of risk management and discipline. You want to grow your account, you need to have something solid like this. This is the setup which I was talking about. You need to have a setup before even starting with technical analysis. You need to know ironclad how much you're going to lose, how much you'll be making. and you'll only be taking trades which satisfies this requirement, and you will stop trading if you lose 2 trades in a particular day, and if you stop trading if you continuously lose 4 trades in that particular week. Yes, you will be down $96 for that particular week, but let's say the next week you win 2 trades, or just say even 1 trade, you're back to break even. And if even if you take like 6 trades, you lost in that 6 trades and you win in 3 or win in 2, your P&L is still going to be in positive. Now that is how the proper risk management works. You can have a completely shit win rate. You can have a win rate of 30% and you can lose 70% of the trades you take. Even with that 30%, your P&L will still be up. As long as you get to that level, it doesn't matter what way you use to analyze the price. It doesn't matter if you use volume profile. It doesn't matter if you use depth of market. It doesn't matter if you use like MACD or RSI. It doesn't really matter. At the end of the day, you're not losing money because the indicators are shit. You're losing money because your risk management is shit. There is a big difference. It's easy to blame the indicators which you're using and not your own, because taking responsibility, I'm not blaming you, it's just a defense mechanism which the brain does for its own self. Whenever it feels threatened, it goes defensive. By going defensive, you start blaming others because that's the defense mechanism which your brain has employed. So it happens, you need to break that. Simple as that. You need to break it. You need to start taking responsibilities. You're losing not because of the indicators, it's because of the risk management. It's the bad risk management. You let your losers run by a lot and you cut your winners too quick. The ratio, the math doesn't make sense. Why are you okay in taking more losses and not okay letting the profits run? If you belong to one of them, you got to make some changes fundamentally in your system. Now, the conclusion, the final slide. The example which I gave you, the 1.2:4. A lot of traders have their own risk to reward system. Some traders use 1:2. They'll risk like $10 to make $20. If they lose it, they'll just lose the 10. So some traders will have 1:5. They'll risk $10 to make 50. It depends. You can sit down, take a notepad and build your own system. You can do that. Now, this is just an example of the system which I follow, and you can alter it based off of yours. And that system shouldn't be like 10% stop losses in options, 5% stop losses in the option contract bullshit. Remember, the average losers, whatever you got, should be less compared to that of the average winners in dollar amounts. You can lose in 100 trades, I don't care. Who doesn't lose? Everyone loses. Everyone loses in their trades which they take. Not one single trader is 100% win rate. Doesn't matter what your win rate is. Now, even if you're winning in 30 trades out of the 100, your P&L should be in a positive territory. Now, just like how they halt the stock market after an exaggerated move to the upside or downside, you gotta stop trading to get your mental state back on track. As I said before, we covered it before. If you lost in 4 trades continuously, 24, 24, 24, 24, continuous hit, you just lost $100 in 2 days. If your account is $2,000 and if you lost $100 in 2 days, that's going to have a big impact in your psychological state. You need to take a break before continuing with the next trade, because it takes a matter of minutes for your brain to switch from I got to focus on risk management to I got to recover my losses back. It takes literally a minute for that to click in, and then once that clicks in, you take the decisions which you don't want to take, and it completely spirals out of control, and then when you wake up and you see your account is back to $1,000 again. This is a business, treat it like one. And unfortunately, unlike other businesses, in this business, it's your main competitor is you. It's you versus you at the end of the day. It's not you versus some hedge funds who is like somewhere in his ivory tower. It's you versus you. Again, take high probability trades, manage the risk wisely. If you guys have any questions, you can shoot it in here. I'll be here for a while and we can go over some charts and see what's going on with the markets. And this slide has been sent to the members of the Patreon in the live stream section. So if you missed the stream, you can come back and you can take a look at it anytime you want. That being said, I'll see you guys in the chat. Thank you so much for joining. Leave a like, subscribe, really appreciate it. Have a good one.